Well, thank you very much. You may know Phil Lowe had a cup saying glass half full. When I arrived, I had a cup made saying glass half empty, and I presented it to Michelle Bullock. She wasn't very pleased with that, but anyway, we have a duo now, so we cover the territory. In the late 1980s, as the Iron Curtain fell, the US Army War College threw away its old Cold War playbook. In its place, trainee strategists were taught to see the world as volatile, uncertain, complex, and ambiguous, or VUCA for short. The implications were far-reaching. Out went the old certainties, and in came a new approach that stressed the importance of approaching problems from different angles, drawing on multiple perspectives, learning from mistakes, making robust decisions, and communicating openly about uncertainty. Where the military began, the business world followed, and VUCA begat 1 million Harvard Business School articles. Inevitably, perhaps, the concept lost some of its shine in the decades that followed, but today it's back with a vengeance. The rules of global trade are being turned on their head, new geopolitical realities are dawning, artificial intelligence, the energy transition, demographic change, the long shadow of COVID, all changing our concepts of economic activity and work. And Australia, like elsewhere, is seeking new sources of productivity growth. With the world in flux, companies, households, and governments must change how they think, act, and plan, just like those army cadets of the 1980s. Monetary policy can't affect those profound changes, but it does have one key job, and that's to ensure that of all the things people do have to worry about, inflation isn't one. High inflation hurts everyone. It hits living standards, particularly for those on low and fixed incomes. It disrupts households and companies' plans, and the past few years have been a vivid reminder of that. Around the world, core inflation reached multi-year highs. Uncertainty rose sharply too. Forecasting prices during the pandemic was harder than at any time in the past quarter of a century for central banks and for everyone else too. And that left inflation much higher up people's VUCA worry lists than it should be, harming livelihoods, crowding out focus on the economic choices that households and companies should be spending their time on. Our job is to put that into reverse, returning inflation to the background where it belongs. In my remarks today, I want to review progress towards that goal, and I'll start with the good news. Inflation is down and employment is up. We seem to be moving on from the narrow path. But monetary policy must always look ahead, and here, as you said, I want to discuss two decidedly VUCA risks that shape that outlook: the prospects for world trade and the degree of spare capacity in the labour market. While Australia's had much the same post-COVID pickup in inflation as everywhere else, our monetary policy response was different. Interest rates rose significantly, but they never reached the levels seen in many other developed countries. That was an explicit choice, grounded in our mission to bring inflation down, but at a pace that helped preserve sustained full employment. An implication of that strategy, clear from the start, was that just as interest rates rose by less, so they would also fall less far and less quickly. There were always risks on both sides of that narrow path, and people regularly called them out. Some said the RBA should have tightened more to bring inflation down faster and earlier, and we could have done that, but that would have risked materially higher unemployment. Others said we should have eased more quickly to help kickstart economic growth, and we could have done that too, but it would have risked inflation being higher for even longer. In the board's judgment, both alternatives would have left the Australian people worse off. That's why the latest economic data are encouraging. Year-ending trim mean inflation, our preferred measure of underlying price pressures, fell to 3.2% in the December quarter. That's 0.2 percentage points lower than we expected in November. Amongst other things, that reflected lower inflation in new dwelling costs, rents, market services, all of which have been stubbornly persistent. Measured on a shorter two-quarter annualised basis, trim mean inflation is well into the 2 to 3% target range. While inflation has moderated, employment has continued to grow extraordinarily strongly. That's true compared with other developed countries, as I've shown here, and with our own history. 64.5% of the population now have jobs. That's the highest on record. By contrast, of course, economic growth has been subdued, particularly in the private sector. But here too, there's now cautiously better news, with partial indicators suggesting household spending picked up in the December quarter, and GDP growth is projected to rise back to trend over the forecast period. We get the national accounts later today. The central banks are paid to worry, not to celebrate, and monetary policy works with lags, so it must be set with an eye to the future. Let me talk about two uncertainties that shape that outlook. Now, to the naked eye, the four words in VUCA seem just different words for chaos, but in fact their meanings are different. Volatility means rapid change, unpredictable or predictable. Complexity means a world of multiple overlapping causes and effects. Uncertainty, in the classical sense, means you know the model, but you don't know the parameters, so you have to estimate an imperfect forecast, but if you get better information, you make a better forecast. The tricky one is ambiguity, because it means you don't know the model, so any model-based forecast will break down, and feeding just more information into the same model doesn't help you much. In situations of ambiguity, judgment and instinct are as important as formal analysis. These concepts can help us think through the implications for Australia of global trade policy uncertainty, which this chart shows is at a 50-year high, although you probably didn't need a chart to tell you that. Economists' inclination is to approach this as an analytical problem. We might note, for example, that from a macroeconomic perspective, Australia's direct exposure to US tariffs levied on our exports is limited. We're right down the very bottom of that chart. You can hardly see us. And such an analysis might turn quickly to the fact that we're heavily integrated into and reliant on the global economy more broadly. In fact, on some measures, for example, this one I've shown here, we are uniquely vulnerable. Hence, the bigger macroeconomic risk for us would be the imposition of US tariffs on third countries triggers a global trade war. Australia's long history shows that we thrive when trade, labour and assets flow freely, but suffer when countries turn inwards. In principle, it's possible to estimate the quantitative impact of policy alternatives on Australian activity and inflation, but the number of assumptions required is daunting. You need to know the scale, scope and persistence of US trade measures. You need to know what policy reactions there will be, whether retaliation or stimulus. You need to know the reaction of financial markets, including, importantly, what the exchange rate does. And you need to know how global trading firms are going to react. Our February statement on monetary policy included 3 stylized scenarios involving different sets of these assumptions, and all of them suggest that if these things come to pass, you will see somewhat lower GDP growth in Australia, but the impact on inflation is ambiguous. It might go up, it might go down, depending on whether the supply or demand effects dominate. But the number of alternatives is almost infinite, and given the large uncertainties at this stage, we didn't put any of those scenarios into our central forecast. Up until very recently, financial markets also appeared to be placing very little weight on a severe adverse scenario. Measures of implied volatility in equity, bond and foreign exchange markets were subdued. Estimates of equity risk premium, like the one I've shown here, were pretty amazingly close to their post-global financial crisis lows. And equity investors appear to have taken out only very modest extra downside insurance in response to the early flurry of news about tariffs. You can see that in the left-hand tail here. There's several reasons why this apparently benign market reaction may have happened. Investors might have thought that tariffs were just a negotiating tool with limited implications for the medium-term economic outlook. They might have believed other promised US policy initiatives, including fiscal measures, deregulation, would more than outweigh the impact of tariffs. They may have believed that demanding countries outside the US would be insulated by adjustments in the exchange rate and stimulus, as happened last time round. Or they may simply have believed that US policymakers would again show limited tolerance for declines in equity prices. That confidence seems to have taken a bit of a knock in recent days. Some of that reflects recent US data. Some may reflect a dawning understanding that some of the policies involved may have slightly bigger impact. But some of it may simply be a recognition that if companies and households come to conclude that trade policy uncertainty isn't sort of classical uncertainty, if you like, carry on until the fog lifts, but genuine ambiguity, i.e. almost anything could happen, that they may choose to just batten down the hatches, postponing planned spending, particularly on long-term investment, until things become clearer. This sort of watchful waiting is pretty sensible individually, but for an economy it can be bad news, and as the economists put it recently, tariff uncertainty can be as ruinous as tariffs themselves. The Federal Reserve estimated that heightened uncertainty over trade policy, not trade policy itself, reduced global GDP in 2019 by about 1%. And that earlier graph suggests that policy uncertainty this time around is much bigger. That possibility that the uncertainty alone might bear down on activity was a part of our policy deliberations here in Australia in February. A second key uncertainty lies closer to home in the labour market. While the recent strength in employment growth is welcome, it's also pretty unusual after a period of such subdued GDP growth. And the question is, what does that mean for the margin of spare capacity in the economy and hence for the inflation outlook? Now, assessing that question is harder than it might seem because spare capacity can't be directly observed. Its sustainable level has no set value and likely changes over time as the structure of the economy evolves. And some people conclude on the basis of that it's a pretty useless concept, and that's fine, but then they need another story about what makes inflation. What makes inflation. We prefer to give the concept some weight while recognising the pervasive uncertainties. Now, an obvious place to start when assessing labour market capacity is to look at proxy measures. Two of the most important are unemployment, that's those looking for work, and underemployment, those in work but wanting to work more hours. And as recently as November, we were projecting that unemployment would rise to 4.25% by the end of last year and 4.5% by the end of this year, as past week activity reduced hiring rates. In fact, unemployment has remained at or around 4%, and underemployment has fallen back to late 22 levels. Other capacity measures have also stabilised or reversed, including the ratio of vacancies to unemployment, and surveys of firms reported labour constraints. Now, with GDP growth projected to pick up in 2025 as private demand recovers, these developments have caused us to revise down our central projection for unemployment. But the implications of that for inflation depend on where that leaves spare capacity relative to sustainable levels, and two considerations suggest that labour market conditions are relatively tight. First, all of the measures in that graph lie some distance above their historical averages, and unemployment is in fact close to its lowest level at any time for 50 years. That can't be the end of the matter because the levels of nominal wage inflation associated with a given level of unemployment have fallen over that period. So the sustainable level must be lower too. How much lower, no one can say, but you can back out some estimates. Those analytical approaches all suggest that while sustainable unemployment levels are likely to have fallen in recent decades, current labour market conditions still appear relatively tight. And combined with that lower unemployment projection, that would suggest somewhat greater upward pressure on inflation from the labour market over the medium term. Exercises using the other measures in that chart give you much the same conclusion. But these are critical judgments, and knowledgeable people have suggested we might be being too pessimistic. We take those challenges seriously. Some point out that business surveys of employment intentions have been at or slightly below long-run averages, and that's true, but such surveys typically focus on the market sector on the lower part of this chart, where employment growth has been subdued, not on the non-market sector, which has accounted for most of the recent strength in aggregate employment, as you can see on the top panel. That then leads to a different challenge, that non-market employment has limited influence on aggregate wage and inflation pressure because it draws on a different pool of labour. But it's hard to find support for that in the data. For example, the healthcare sector, which has been a big contributor to aggregate employment in recent years, has drawn quite materially on workers from other industries, helping to equalise cross-sectoral wage growth. Something similar you can also see in construction. A third argument against the view that labour market conditions are relatively tight notes that nominal wage growth has been easing, as shown here. But with measured productivity growth, as weak as it has been recently, that still implies elevated growth in companies' unit labour costs, and some of that apparent strength could reflect under-measurement of productivity growth or a temporary burst of real wage catch-up, rather than labour market tightness, but those effects would have to be pretty large to account for the whole of the gap. Drawing that all together, our central projection reflects a judgment that labour market conditions will remain relatively tight over the forecast period and a bit tighter than assumed in November. At the same time, we've recognised the risk that recent inflation data may suggest we've overestimated the capacity of the extent of excess demand by applying a little downward judgment on the inflation profile, and we set out what you'd need to believe to justify an even larger downward adjustment as a risk scenario. So what's all this mean for policy? This slide compares the central projection for trim mean inflation in February in pink with that in November in blue, and you might have to squint really to see the difference. Inflation is a bit lower in the short term, reflecting that downside news on inflation and wages and activity, but it's a little bit higher further out, stabilising slightly above the midpoint of our target range, reflecting the surprising strength in the labour market. So a bit above the midpoint of the target range, why on earth did we cut rates? Did we reject the staff forecast, as some people have claimed? Did we suddenly and confusingly relax our previously stated intolerance for persistent inflation deviations from target? Nothing of the sort. For me, at least, the rationale is relatively simple. First, the encouraging news on price and wage inflation gave us somewhat greater confidence that underlying inflation is on track to return to the target range in the near term, if anything a bit more rapidly than we'd expected. But we noted that the combination of lower inflation data and that lower near-term projection for inflation actually puts Australia, which is in the middle of those blue bars, in a very similar position to where other countries were ahead of their first rate cut, most of which happened some time ago. Second, however, the board also recognised the uncertainties about the outlook for inflation become larger the further out you go. One uncertainty relates to future changes in the cash rate. Now, all projections have to assume something about this path, and by convention we assume it follows market expectations. Just to remind you, in February that curve implied up to 4 25 basis point cuts over the forecast horizon, a somewhat more front-loaded pace than had been true in November. In light of the data then available, including the strong labour market, it was not clear to the board that a rate-cutting cycle of this depth was likely to return underlying inflation sustainably to the midpoint of the target range, and the projections that we published are consistent with that view. But that didn't mean there was no case for a cut, and to see that, this red swathe here shows an illustrative range of projections for underlying inflation under the alternative assumption of an unchanged cash rate target of 4.35%. And the centre of that swathe, again, you have to squint a bit, lies slightly below the midpoint of the target range, consistent with a bias to cut. But the range of outcomes there in red shows that there were good arguments both for a hold or a cut, and the board discussed them in some detail, as the minutes released yesterday showed. Foremost in that debate were the issues I've discussed today, the outlook for global trade and the degree of spare capacity in the labour market. Now, some have flagged a concern that all of this is a bit like fine-tuning. And it's certainly true that the pervasive uncertainties we've been discussing at this conference are orders of magnitude bigger than the sorts of differences to the target midpoint I've shown here. But the framework for monetary policy agreed between the Treasurer and the board is clear. We set interest rates such that inflation is expected to return to the midpoint of the target range, not because we expect to hit it perfectly, that's probably literally impossible, but because it maximises the chances of inflation remaining sustainably in the 2 to 3% range. The rate cut in February reduces the risk of inflation undershooting that midpoint, but the board didn't share the market's confidence that a sequence of further cuts will be required. That assessment will, of course, evolve as time proceeds, and time has already moved on in the past couple of weeks, as further data help us distinguish between different narratives for the economy. Interest rates will go where they need to go to maximise the chances of keeping inflation sustainably in the band while helping to sustain full employment. Progress towards that target has been good, but it's too soon to declare victory. Many households and companies are continuing to struggle, and the board will continue to take decisions, meeting by meeting, in the interests of all Australians. In doing so, our goal, as I said at the start, is to remove inflation from the list of things people have to worry about, leaving them free to focus on navigating an increasingly VUCA world. Thank you. if you want to.
Thanks very much, Andrew, and great to have you here. You've been in Australia about a year now after moving over from the Bank of England. You mentioned there in that speech that we're moving on from the narrow path, and that's a precarious path that both Philip Lowe and Michelle Bullock have spoken about. Are you suggesting that Australia has indeed achieved being able to straddle that narrow path and being successful in getting inflation down without what some people might say smashing the economy?
Don't know why you use that quote, John. We're not declaring success. We've made good progress. People did doubt whether inflation would come down. Everyone did, including us. We were unsure. It has. And employment growth has remained strong. But we're not there yet. And central bankers sometimes use these rather tortuous analogies of the accelerator and the brake and all this kind of thing. We've taken our foot a little bit off the brake. We haven't got our foot on the accelerator.
And as a foreigner who's come to Australia, there's lots of business people in the audience here. What's your sort of a very brief synopsis, observation of Australian economy and business generally?
What, now or over time? Or well, let me not ask you that, so I can exploit the ambiguity in the question. Yeah. Well, as was said at the beginning, I think the long history of Australia should give people confidence. It does, I think, give people confidence. Australia has proved extremely nimble at understanding and reflecting the changing trends in the global economy. I personally have confidence that will happen again. It may not happen tomorrow. It may take time. It often does. But just as, there's this phrase, lucky country, I'm not sure that can possibly be right, given how many times Australia has got it right over its long history. So that's a medium-term point. Clearly, as I say, the role of monetary policy is to bring inflation down and to help support employment. Clearly, as has been discussed throughout these 2 days, productivity is the key underlying issue, and it's not something that monetary policy can do anything about. People often use this slightly hackneyed phrase from Paul Krugman that, productivity may not be everything, but it's almost everything. It provides the engine of growth that everyone else can benefit from, and, that isn't something that monetary policy can affect. It's something we have to react to.
Do the recent ructions in global trade in recent days make a potential future rate cut more or less likely for Australia?
Obviously that's an interesting and important question. As I said, it seems very unlikely that, too many negatives. It seems likely that a global trade war, if it begins, I don't think we know if it's beginning yet. There's so much the announcements are changing by the minute, would not be good news for Australian activity. But the challenge about what it means for inflation here is actually quite difficult. Now, people might well say, well, bloody hell, we're paying a lot of money to know what's going to happen to inflation. That would be a fair question. I've got there before you asked me. But look, it isn't at all clear whether a persistent attack on the supply chains of the world economy will bring inflation down because activity falls everywhere, or actually impairs inflation because our ability to buy cheap goods from other countries is harmed. And so we will have to keep a very close eye on what this means for inflation. And if inflation were to pick up, we'd have to respond in one way. If inflation falls, we'll respond in another.
You mentioned the market sell-off in recent days is obviously partly a reaction to what's going on with the tariffs tit for tat, but you also did just hint there that there's been some somewhat concerning US data. Yeah. I'd call it soft sort of leading indicator data, consumer confidence, consumer spending, inflation expectations. We had a lot of Wall Street titans speaking here yesterday, very bullish on the US economy, but are you a little bit angsty or concerned about some of that early data that's coming out of the US?
I hesitate to I have no comparative advantage relative to the people you were speaking yesterday in terms of my insight into the US economy. I think, look, the markets had and probably still have, and there'll be many in the room who are trading in those markets, a very bullish view, not just about the underlying strength of the US economy, which has been a strong narrative for some time and has obviously been justified by the productivity and growth outcomes in the US, but also for what the new administration's policy package, taken in its entirety, would likely mean for the corporate sector, let's say, the deregulation agenda, the fiscal boost. Now, neither of those things have really started to be discussed yet, and some of the potential pain has been discussed up front. And obviously, it was very hard, as I say, to find any recognition even of the risks of that in market pricing. Some of that is adjusted. I think, look, I mean, there's been a lot of discussion in recent days about the Atlanta Fed's projection for Q1 growth in the US, for example, which is some spectacularly negative number. That's because the US always annualizes everything, so 0.1 becomes 0.4 and all the rest of it. There is a possibility that growth could be negative in the US in the first quarter of the year. I don't know that that should make one think, gosh, suddenly the US economy has fallen off a cliff. But I do think it's possible that the financial markets have been a bit, let's just say they've seen the most positive side of the possible implications of this policy package, and there may be some realisation that that may not be quite right.
Michelle Bullock said after cutting interest rates a couple of weeks ago that it was not a lay-down misère decision. That it was
I had to look that up. I don't know what a lay-down misère is. Can you explain that to me?
I'm a bit hesitant to go there, Andrew. I might get myself in trouble.
Because you don't know, or
well, that, but also, yes, let's leave it at that. But also she said it was a difficult decision. Without going into specifics and details, I mean, how robust or vibrant is the debate around the Reserve Bank board table since you've joined?
Yeah, look, I mean, I think you come in and people say, oh, this is a non-expert board and, you know, it's different from other, and obviously, as you know, I come from the Bank of England where the Monetary Policy Committee consists largely of expert economists. I wouldn't necessarily advocate that model as being the best of all possible worlds. You get individual accountability for a lot of headstrong economists. It can mean a lot of very long speeches explaining why they have a very idiosyncratic view. Whether that adds to the signal or the noise of monetary policy, I think you could, you know, actively debate. So I don't think there's a single model. I didn't know what to expect, but the reality is that the people around that table bring an enormous amount of judgment and knowledge and insight to that policy debate. And I can't think of, not one of them is a shrinking violet, not one of them. And as I said at the beginning, when you're in these situations of ambiguity rather than, sorry to use a pompous phrase, you know, classical uncertainty, it's judgment and you know, instincts that matter almost as much as crunching numbers through large models that may not be the right model of the economy. And having the expertise, having that judgment around that table from a variety of different backgrounds, I think has actually served us and Australia quite well. Has the debate been as robust as I've been used to? Yes, it has.
One of the justifications that you've pointed to publicly in the last couple of weeks for the rate cut was that the board was shown some staff forecasts privately that if you held the cash rate steady at the previous 4.35%, you would actually slightly undershoot the midpoint, the 2.5% of the inflation target. And so that gave you confidence to cut rates because you're going to undershoot the inflation target by a little bit. But over what time frame are we talking there? Because people in the markets are keen to know a bit more about that, because surely it wouldn't have made much difference if you cut in February, say, versus May. How long would you have to hold it to that rate for to undershoot inflation?
Well, I showed that red swathe earlier. It's not quite the chart we looked at internally, but it gives a good sense of it. It's a modest undershoot over the forecast period, so 18 months to 2 years. And you're absolutely right. It's a judgment as to when you cut rates. And so as well as the central case, which was clearly suggesting something of an undershoot, which wasn't the forecast we published, which was based on the market curve, you're also thinking, the board is also thinking about the risks around that central case. Now, for a long period prior to February, the board was still worried, as I think many were, about the upside risks to inflation, not least from inflation itself getting built into price setting and wage setting. As inflation has come down, some of those upside risks have moderated, and some of the downside risks that we've spent a lot of time in the last 2 days talking about, the risk from global trade and the possibility that the labour market is slightly looser than our central view, I think weighed on the board. And so you're absolutely right. You could have made a decision in February, you could have made a decision later. It wasn't 50-50, but it wasn't 90-10 either, and that was, you know, what the market had thought about. So combination of the undershoot, which was modest, plus the balance of risks, I think explains why the board made its decision.
In the detailed statement of monetary policy released on the same day, the bank revised its guesstimate, I'd say, for what's known as the neutral interest rate, and that is where interest rate is neither stimulatory nor contractionary. It was previously up around, you estimated, 3.5% to 3.75%. You're now saying we think maybe it's around 3%. Does that mean actually you've held interest rates tighter and more aggressive than actually what you previously thought, and actually you could potentially over time cut rates by more because you think the neutral rate's lower than previously?
No, so the chart you're referring to, I haven't got it here, perhaps I should have done, actually shows, of course, an enormously wide range for the estimates of the neutral rate by memory from something like 1 to just under 4. So that is a huge range, 3 percentage points. If you imagine, well, we said, well, maybe we'll cut interest rates to 1%, people might rejoice, but that's a huge decision to make. That chart did not play, and the minutes show this from yesterday, a central role in the committee's policy decision. They are estimates based on partial financial market data, and really you can only draw two conclusions from it. One is that the range of uncertainty is very large, and the second is that all the estimates lay below both where our rates were before the decision to cut and afterwards.
Well, I do want to go to the floor to give others a chance to ask a question to the Deputy Governor. So if you have a question, please raise your hand. Just in the meantime, as we get a microphone to anyone who raises a hand, Dan asks here virtually, what were your thoughts on Stephen Schwartzman's suggestion of moving to a more Americanised system of 30-year fixed mortgages, more specifically the ability for the RBA to reduce inflation, a system like that?
Yeah, so this is an interesting point. Australia, of course, is at one end of that global spectrum in terms of almost all of its mortgage stock being related to the floating interest rates. I think Norway is another one. The UK used to be very like Australia, but has actually moved over time to slightly more fixed situation. The big point that's often not mentioned in the US is, of course, that the 30-year fixed mortgage market is based on a subsidy by Fannie Mae and Freddie Mac, which stands behind that market. Now, it's not crystallised, that subsidy, in recent years because it's been successful in sustaining that market. But I would say that's a social choice. And the social choice to stand behind the provision, actually the extensive risk that banks face in providing long-term mortgages of that kind, is not one I think Australia has yet made. I'm not sure whether it would, given the view that people often seem to express about the banking system, which it would effectively be a backstop for. But it could be considered. I think one of the lessons from the UK experience is that a period of sustained low inflation will often lead people to begin to choose fixed rate mortgages as opposed to floating rate mortgages. I don't think that's really happened here to a great extent. I think there was a pickup, if I understand the data correctly, during COVID, but from sort of nothing to not much. I think that's rolled off since then. So it would definitely change the transmission mechanism in Australia very substantially, but I think it would be for banks and homeowners to decide if that was the kind of risk they wanted to take.
And we'll just correct that question. It was actually BlackRock's Larry Fink who made that suggestion, not Stephen Schwartzman from Blackstone. I easily confused that.
Has he emailed you already?
Yes. Would anyone like to ask a question? We've got Michael Stutchbury, editor-at-large here.
Are you allowed to call your ex-boss?
Thanks, Andrew.
Are you doing it anyway?
Yes, he is. Yes, he is. Andrew, just a question about the strength of the labour market. As your graphs show there, the really extraordinary tightness of the Australian labour market compared to other comparable economies. Now, maybe some people might say it's because of all the government money that's been pumped into the care economy and so forth. But even with that, do you think that this is a cyclical thing, or are we in now a post-COVID structural period where before that everybody worried about, well, there's not enough jobs to go around, and now that we're going to be worried about, well, where is the labour out there because there's so many labour shortages? Is that an ongoing structural thing that the Reserve Bank now faces?
And just to correct slightly, Michael, that chart that I showed, the comparison with other countries, was just for employment. It wasn't a direct measure of labour market tightness. The measures of labour market tightness were the unemployment rates and the vacancies over unemployment and that kind of thing, which are low relative to other countries, unemployment, but not as spectacularly low as the employment rate is above. There is a substantially higher participation rate in Australia, which is a good thing relative to many other countries. I think the world you describe, where companies may be more actively having to think about what it will take to retain their staff and also attract new staff than perhaps in a world of substantial unemployment, probably is the world of the future. And obviously there's a difference between that being a sign of an active, well-functioning labour market in which talent can bid itself around to an appropriate price, and one where the labour market is overheating. The possibility that it will lead to the labour market overheating is something we're very alert to. But the possibility as well that actually Australia has found a bit of a secret sauce here in terms of the market being more efficient, being more capable of distributing talent around the various people using for it, is something we should be putting weight on too. And anyone who says, well, the labour market is super tight, it's obvious that inflation is going to the moon, has to explain why in fact inflation and wage growth, at least at the time for the moment, is falling rather than rising. But the scenario you describe where companies having to spend more time retaining and recruiting staff in the future probably is one where you keep the economy relative to full employment. That may be here to stay.
I do want to give an opportunity to squeeze in one final question, if anyone in the room has one. All right. Looks like we are on time anyway, Andrew. So thanks very much for joining us. Deputy Governor of the Reserve Bank, Andrew Hauser.